Well, one of the problems with looking at gold is that really a lot of analysts are just looking at the price. Anybody who's saying that gold is in a bubble, they're simply looking at gold in terms of the US dollar or maybe the euro. However, if you look at gold in terms of the increase in money supply, I think you'll find that it's a different story. There are also several indicators that suggest that gold is not in a bubble. For example, if we look at gold reserves and gold-related equities as a percentage of global assets, we'll find that it's extremely low. Historically, gold and gold-related equities represented around 20 to 30% of global assets. In fact, in 1981, if we look at the percentage it represented after the gold price had subsided, it was still at 26%. There's also a study carried out by Steinbeis University in Berlin that shows us that German investors have only got 2.8% of their private wealth allocated to gold. That was carried out in November 2011. This is a surprise given that Germany will be considered one of the largest private investors in gold. And if we look at the 200-day moving average for gold, it's consistently tracking that 200-day moving average. If there was a bubble in place, this would also be represented by a parabolic phase, also known as a blow-off top. Also, if we look at investments into gold-related equities, we can see that there's been very little investment. In fact, Eric Sprott has shown us from Sprott Asset Management that between 2000 and 2011, that only 78 billion has been invested into gold-related equities. Now, just to put this in perspective, this is the same amount of money that went into tech stocks in the first 3 months of 2000. This represents quite a small amount of money and indicates that gold is not in a bubble. The last thing maybe to look at would be the media. At the moment, we still see most of the advertising related to gold is for people to sell their gold, not to buy it. This would also be another indicator that gold is not in a bubble. Gold is now, once again, trying to catch up with the money supply, with the additional pressures of emerging markets and supply constraints.